8938 versus FBAR versus FATCA, the ultimate breakdown. So you did your due diligence, you meticulously reported your foreign bank account and thought, great, I'm all compliant with US law. But what if I told you that a single unchecked box on a form you might not even know exists could trigger penalties that wipe out half of the account value? It's a costly mistake, and a shocking number of Americans are making it. In this video, we're going to untangle the confusing web of FBAR, FATCA, and Form 8938 to make sure you're not one of them. Hello and welcome. If you're a U.S. citizen, green card holder, or U.S. entity with any kind of financial footprint outside the United States, you've probably heard the acronyms FBAR, FATCA, and maybe Form 8938. It's easy to think they're all the same thing, or that filing one of them has you covered. Honestly, that assumption can be a recipe for total disaster. The reality is these are three separate reporting requirements with different rules, different thresholds, and different government agencies keeping watch. The overlap is messy, and the penalties for getting it wrong are severe. I'm tax attorney Chad Silver, the founder of Silver Tax Group. I've helped hundreds of clients navigate this exact minefield for about 20 years. At Silver Tax Group, we build your foreign account defense, we submit your defense, and we'll defend it if necessary. Don't wait for that scary letter from the IRS or FinCEN. Call us at Silver Tax Group. I guarantee you'll hear the real deal truth about the situation and talk to extremely knowledgeable people who do this work every single day. We'll look at your situation, figure out your exact filing requirements, and build a strategy to get you fully compliant and protected. My goal today is simple: to give you a clear, straightforward breakdown of each so you can protect your assets and stay on the right side of the law. Let's get into it. Section 1, the problem, a triangle of confusion. The heart of the problem is that two different government bodies want to know about your foreign assets: the IRS and an agency called FinCEN. The trouble is they ask for this information in very different ways and for slightly different reasons. This has created a confusing system that can easily trip up even the most careful taxpayer. Picture this: John is a US citizen living in Germany. He's got a local bank account, a small company pension, and some stock he inherited in a German company. He knows he needs to report this bank account, so he files the FBAR, and he thinks he's done. A year later, gets a letter from the IRS, lands on his desk with a big fat $10,000 penalty notice. Why? Because while he reported his bank account to FinCEN, he failed to report his other assets to the IRS on a totally different form. This happens all the time. We see it all the time. You can do everything right on one form and still face these devastating penalties because of another. These forms have similar names and report similar information, but they're not interchangeable. Let me say this clearly: filing Form 8938 with your tax return does not satisfy your FBAR requirement. And this is the trap. Let's break it down, starting with the most common one, the FBAR. Section 2, FBAR, the broad net. First up is the FBAR, FBAR, which stands for Report of Foreign Bank and Financial Accounts. The most important thing is to remember here that the FBAR is not a tax form. It doesn't go to the IRS. It's filed with a different bureau of the Treasury Department called FinCEN, the Financial Crimes Enforcement Network, the Criminal Enforcement Network. Its main job is to help the government track and prevent money laundering. Who has to file FBAR? The rules apply to all U.S. persons. This is a wide net that catches U.S. citizens, green card holders, even U.S. citizens living abroad, and U.S.-based entities like corporations, partnerships, and trusts. It doesn't matter where you live. If you're a U.S. person, this applies to you. You have to file an FBAR if you have a financial interest in or signatory authority over financial accounts that are foreign, and the total value of all those accounts hits more than $10,000 US at any point during the year. The $10,000 threshold explained. This is probably the most misunderstood part of the FBAR. That $10,000 limit isn't per account. It's the combined maximum value of all your foreign accounts added together. So if you have 3 separate accounts and each one hit $4,000 for just one day, your total would be $12,000, and that triggers an FBAR filing requirement. And you have to report all 3 accounts. Even an account with a zero balance has to be listed if your combined total crosses that $10,000 line. The FBAR is for reporting financial accounts. This includes the obvious stuff like foreign checking and savings accounts, foreign brokerage and securities accounts, foreign mutual funds, foreign issued life insurance or annuities with a cash value, most foreign retirement and pension accounts. And here's a big one that trips people up. This also includes accounts where you have signatory authority over, but no financial interest in it. For instance, if you can sign checks for your elderly parents' account in another country or for your company's foreign operating account, you might have to file an FBAR, even if none of the money is actually yours. Like, how unfair is that? How and when to file the FBAR? The FBAR is filed electronically through FinCEN's BSA e-filing system. The deadline is technically April 15th, just like your tax return, but there's a super friendly automatic extension to October 15th. You don't have to file anything extra to get that extension. Section 3, FATCA and Form 8938. The IRS gets involved. All right, let's switch gears to FATCA. FATCA stands for the Foreign Account Tax Compliance Act. This is a law from 2010 designed to fight offshore tax evasion. FATCA does two main things. First, it requires foreign banks around the globe to report information about their American clients directly to the IRS. Second, it requires U.S. taxpayers to report their own foreign assets to the IRS. That individual reporting is done on Form 8938, the Statement of Specified Foreign Financial Assets. And that's the crucial difference. Unlike the FBAR, Form 8938 is a tax form, and it gets attached directly to your annual Form 1040 tax return. Who has to file Form 8938? You need to file Form 8938 if you're a specified individual and your foreign assets are worth more than certain thresholds. A specified individual is basically a U.S. citizen, a resident alien, or certain non-resident aliens. Here's the key. You only have to worry about Form 8938 if you're already required to file a U.S. income tax return. If you don't have to file a tax return, you don't have to file Form 8938 no matter how big your foreign assets are. The Form 8938 thresholds, and it's complicated. This is where it gets a lot more complex than the FBAR's simple $10,000 rule. The filing thresholds for Form 8938 depend on your tax filing status and whether you live inside or outside the United States. For taxpayers living in the U.S., single or married filing separate, you file if your foreign assets were over $50,000 on the last day of the year or over $75,000 at any point during the year. Married filing jointly, you file if your assets were over $100,000 on the last day of the year or over $150,000 at any point during the year. Now, for taxpayers living abroad, the thresholds are much higher, recognizing that expats would naturally hold more assets for like daily lifestyle. Single or married filing separate, the threshold is over $200,000 on the last day of the year or over $300,000 at any time during the year. Married filing jointly, folks, the threshold is over $400,000 on the last day of the year or over $600,000 at any time during the year. What do you report on Form 8938? Form 8938 asks about specified foreign financial assets, which is a much broader category than the FBARs. It includes all the financial accounts you'd list on the FBAR, plus other assets that aren't held in an account. This can include stocks, securities from a foreign corporation that you hold directly, an interest in a foreign partnership or other entity, bonds or debt issued by foreign persons, financial instruments like swaps or options with a foreign counterparty, an interest in a foreign estate or trust. Common questions about real estate. Good news, if you directly own a vacation home in Italy, you do not need to report it on Form 8938. However, if you own that same property through a foreign corporation or partnership, you do have to report your interest in that entity. And here's the biggest takeaway. If you meet the filing threshold for Form 8938, you almost certainly blown past the much lower $10,000 threshold for FBAR. This means many people need to file both forms. Filing one does not, and I repeat, does not mean you satisfied the other. Section 4, the penalties. Why you can't afford to ignore this. The reason why we take this so seriously is that the penalties for getting this wrong are absolutely staggering. FBAR penalties. The FBAR penalties for failing to file an FBAR are particularly brutal. A non-willful violation, meaning you made an honest mistake, can bring in a penalty of over $16,000 per account per year. This amount is adjusted for inflation. A willful violation where the government proves you knew you should file and chose not to is a financial catastrophe. The penalty can be the greater of over $115,000 or 50% of the highest balance in the account for the year. Yeah, 50%. That can be charged for multiple years, which means the penalties can actually add up to more money than the money in the account. In the worst cases, criminal charges are also on the table. Form 8938 penalties. The penalties for failing to file Form 8938 are also severe. It starts with a $10,000 penalty just for failure to file. If the IRS sends you a notice and you still don't file, they can add another $10,000 for every 30 days you're late, up to a maximum of $50,000. On top of that, there can be a 40% accuracy related penalty on any unpaid taxes connected to those undisclosed assets, and they will certainly assess that. They assess that on just regular balances. These aren't empty threats. The government actively enforces these penalties. The cost of getting professional advice is a tiny fraction of the cost of getting it wrong. Conclusion. All right, let's recap the differences one last time. The FBAR is filed separately with FinCEN, has a low $10,000 total threshold, and is for reporting foreign financial accounts. Form 8938 is filed with the IRS as part of your tax return, has a much higher and more complicated threshold starting at $50,000, and reports a wider range of foreign financial assets. And FATCA is the overreaching law that created Form 8938 and also forces foreign banks to report on their U.S. clients. The most common mistake is thinking these forms are interchangeable. For many U.S. taxpayers with assets abroad, filing both is not optional. It's a requirement. Knowing your obligations is the first step. Don't leave it to chance. If your head is spinning a little, you're not alone. The rules are complex. The stakes are high. And what you need to file depends entirely on your specific situation. Making a mistake, even an honest one, can lead to life-altering penalties. If you're even a little unsure about your obligations, have assets overseas, or have missed filings in the past, now is the time to get clarity. Don't wait for that letter from the IRS or FinCEN. Call us at Silver Tax Group. I guarantee you'll hear a different truth about the situation and talk to knowledgeable people who are experts and do this every single day. We can look at your situation, figure out your exact filing requirements, and build a strategy to get you fully compliant and protected. Thanks for watching. If this video helped clear things up, please hit that thumbs up button and subscribe for more essential tax tips. Stay safe and stay compliant.